Hi everybody, welcome to Chapter 12. In this chapter you will learn about the various approaches we use to account for investments that companies make in the debt and equity securities of other companies. Corporations raise funds to finance their operations by selling equity securities, such as common stock or preferred stock, and debt securities such as bonds and notes. These securities are also called financial instruments and are purchased as investments by individual investors, mutual funds, and by other corporations. In later chapters, we'll discuss liabilities arising from equity and debt securities from the perspective of the issuing company. Our focus in this chapter, however, is on the corporations that invest in the debt and equity securities issued by other corporations, as well as debt securities issued by governmental units such as Treasury bills and Treasury bonds. We'll talk about equity securities in the second half of this chapter. Right now, we're going to focus on debt securities. A debt security has a specified date when it matures. It has a face amount or a par value amount that is paid to the investors at maturity, and in the time between its issue date and its maturity date, interest is paid to investors, frequently on a semi-annual basis. This is illustration 12-1 in your textbook. On July 1st, 2021, Masterware Industries issued $700,000 of 12% bonds dated July 1st. Interest of $42,000 is payable semi-annually on June 30th and December 31st. That $42,000 is calculated by taking the par value or face amount of the bond of $700,000 times half of the contract interest rate. The contract rate is stated for an annual rate of interest. We're paying it twice a year, so the semi-annual rate of interest is 6%. The bonds mature in 3 years on June 30th, 2024. United Group, Inc. purchased the entire bond issue on a date when the market rate for the bonds of similar risk and maturity was 14%. Let's go through the 4-step process to calculate the issue price of the bond. Step 1. Calculate the bond interest payment. And we already did that. Bond interest payment is the face value of the bond times 1/2 of the contract interest rate. $42,000 interest will be paid twice a year for 3 years, so there will be 6 interest payments of $42,000. Step 2. Calculate the present value of the stream of interest payments. If you remember, the present value of a stream of interest payments would be the present value of an annuity. So we're going to use the present value of an ordinary annuity table, table 4 at the back of your textbook. Interest always, when you're looking at present value tables to calculate the issue price of a bond, always use the market rate of interest. The annual market rate of interest is 14%. Interest is paid twice a year, so the semi-annual market rate of interest is 7%. There are this is a 3-year bond. Interest will be paid twice a year, so the number of interest payments will be 6. So the factor taken from the present value of an ordinary annuity table, where n equals 6 and I equals 7, is 4.76654. Multiply one interest payment times that present value factor to get the present value of that stream of interest payments, $200,195. Step 3. Calculate the present value of the face amount or par value of the bond. Well, the par value of the bond is $700,000. We're going to calculate that using the present value table 2 at the back of your textbook. As I said, always, when you're calculating the issue price of the bond and you're looking at those present value tables, always use the market rate of interest. So the number of payments, n equals 6. Semi-annual market rate of interest is 7%, so I equals 7%. And if you look at those tables, you'll see that the factor is 666.34, 0.66634. Multiply that times the 700,000 to calculate the present value of the bond, $466,438. Step 4, add those two present values together and you've calculated the issue price of the bond. That is also the present value of the bond. To determine the issue price of a bond, it's important to understand how investors compare the bond's stated rate of interest with the market rate of interest. If the interest paid by the bond, the stated rate, is higher than the market rate, investors are willing to purchase the bond for more than its maturity value, so it would be sold at a premium. If the bond's stated rate is lower than the market rate, then the investors would be willing to purchase the bond only at amount less than the maturity value, so it would be sold at a discount. In our previous example, Masterware was offering its bonds for a 12% stated interest rate, but investors could have obtained the bonds of similar risk and maturity at a more favorable higher rate of 14%. To attract investors, Masterware had to sell the bonds at a discount. When debt investments are purchased, they are recorded at cost. That is the total amount paid for the investment, including any brokerage fees. United paid $666,633 to purchase Masterware's $700,000 bonds. United would debit the investment in bonds, which is an asset account, for $700,000. It would credit cash for $666,633 that it paid for those bonds. And the difference would be credited to discount on bond investment. United will record interest revenue using the effective interest method. Here's how it works. Masterware's bonds have a stated rate of 12% payable semi-annually. This means that every 6 months, United will receive exactly $42,000 in cash for interest from Masterware. The face value of the bond times 1/2 of the stated interest rate equals the cash interest that will be paid by Masterware and received by United. to calculate the interest revenue, we're going to take the amortized balance of the loan. That's going to be the face amount minus the unamortized portion of the discount. When the bond was issued, the face value minus the balance in the discount account equaled $666,633. That amortized cost times 1/2 of the market rate of interest will calculate the interest income. So let's go take a look at that again. The outstanding balance that they're talking about here is the same as the amortized cost that they're talking about in this column of the amortization schedule. We'll get to this schedule in a few minutes. So for any 6-month period of time, the interest revenue is calculated by taking the net, the amount of the face value of the bond minus any unamortized discount amount. In this case, the first period, the amortized amount or outstanding balance was $666,633 times 1/2 of the market rate of interest to calculate interest revenue. Credit the revenue account, debit the cash account, and the difference is a debit to the discount on bond investment. So every time United receives an interest payment of $42,000 in cash, they're going to credit interest revenue by some amount, some calculated amount, and the difference between the two is going to be debited to the discount on bond investment account. That means the discount on bond investment account, which started out with a credit balance, is going to get smaller and smaller and smaller every month. And here it is. The discount gets smaller and smaller and smaller every month, because every month we debit this account for the difference between the cash received and the interest revenue we calculated. And because the amortized costs on which we base our next period's interest calculation, that amortized cost gets bigger and bigger and bigger every period, because that amount is the $700,000 face value or par value of the bond minus the unamortized discount, or the unamortized discount, which means that the unamortized discount gets smaller, the amortized cost of the bond gets bigger. And the name of the game is to get the discount balance down to 0 at the end of the last payment, and to get the amortized cost up to its par value at the end of the last payment. The important thing to keep in mind is when you get a bond, write an amortization schedule from the first day that you get that bond, and the amortization schedule should look like this. The interest is calculated on the prior period's amortized cost. And the difference between the $42,000 in cash received and the interest income reduces the amount in the discount balance. Well, that's all for this video. When we come back, we'll talk about the 3 classifications of debt instruments. See you next time.